Hi and welcome. In this video, we will continue talking about the stock investing, the relative valuation method. A simpler, better-known metric to estimate a company's valuation is its price to earning, or PE ratio. For companies with a relatively stable earnings prospect, the PE provides a reasonable approximation of the discounted value of its future earnings, as it tells the investor how many times 1 year's earnings the stock price is currently discounting. For example, if a stock is trading at 15 PE, this means that at the current year's earnings E, it will take 15 years to get your money back. 30 PE will take 30 years. Obviously, for an investment, the sooner the better. Thus, the PE is a reasonable yardstick for a stock's evaluations. Everything else is being equal. The lower the PE, the more attractively valued the stock is said to be. However, there are many caveats to this statement. Different industries have different PE ranges. The more stable the industry and the company's earnings streams, and the higher the PE can be without necessarily making the investment expensive. Very cyclical industries tend to present additional challenge. High-growth companies tend to trade at high PE, and low-growth companies tend to trade at low PEs. Valuing a stock is like going to a grocery store. You get what you pay for. If you want to buy the best product, you're likely going to have to pay for it. Our job as investors is to buy as quality a product as we can, a high ROE, strong economic mode business, at as low a PE as we can. There are valued investors who prefer to focus more on the balance sheet related ratios, such as the price to book, the PB, value of a firm. The PB compares the stock price to the value of company's asset minus its liabilities. Are you ready to calculate intrinsic value using the relative valuation method? In practice, this is the method that most professional portfolio managers and analysts use to estimate the value of a company. Go back to your intrinsic value spreadsheet and scroll down to the second section called Relative Valuation Analysis. Steps to use the Relative Valuation Analysis tool. Number 1. Choose a company that you would like to estimate the intrinsic value for. For example, Apple, Google, Netflix, Ford, etc. Number 2. If you fill in the section about the DCF assumptions, the PE of the company should already be calculated in C56. For example, 11. Number 3. You then want to think of 3 or 4 good comparable companies that operate in similar industries and have similar ROEs and growth expectations. If you are buying a house, this is like to go into similar homes in the neighborhood and seeing what they sold for. Number 4. Look at the comparable average PE in C61. Is the average above or below your company? Go to row 63, column C, and decide whether your company deserves to trade at a premium or discount to their peer average. For example, do they earn a premium ROE? Are they growing faster? Are they a more predictable business? If so, then they may warrant a premium. Number 5. C64 is where you put in your target multiple. Use the chart above and comparable company table in your model to estimate a PE ratio. Is it a 15 average, 10 below average, or 20 above average company? What PE ratio range did it trade at the past? Number 6. In F70, you will see the earnings per share estimated 3 years in the future. Review this number and decide whether you think this is a good assumption. Number 7. In row 72, you will see your intrinsic value calculated. If the intrinsic value is significantly above the current share price, then the stock is likely undervalued and you go buy it. If the intrinsic value is below the current share price, then the stock is likely overvalued. There, now you've done it. Compare your DCF intrinsic value calculation to the relative valuation calculation. Did they reach the same conclusion? Student, teacher. Choose one student to explain the concept of intrinsic value to the group. Have the student briefly describe the three ways discussed above, and then choose a company that has a low PE ratio. Why is the PE ratio a commonly used way to value a company? A couple of questions to consider. Number one, referencing your intrinsic value calculation, why is it risky to buy a stock that trades at a high PE ratio? Why is it risky to buy a company that trades at a low PE ratio? Conclusion. Intrinsic value is the true value of a company. This may or may not be reflected in the stock price. A great investor is one that can find a stock that is trading at a significant discount to its intrinsic value. Many valuation techniques exist due to different preferences among investors. Two primary valuation options are discounted cash flow model or relative valuation model. When measuring intrinsic value, we have to take into account a lot of random variables. Therefore, the intrinsic value is often an estimate. Valuation is not 100% precise, but if you are good at it and can continuously find companies that are trading at a discount to their future value, you will be in great shape. Intrinsic value is a necessary lens through which we need to see our investment. A couple of key takeaways. Number one, intrinsic value is what something is worth. Price is what you have to pay. There is not the same thing. Number two, buying stocks below their intrinsic value gives you a margin of safety and sets you up to make money in the market. Number three, the two most common methods for calculating values of stocks are the discounted cash flow model and the relative valuation model. We're also going to talk about quantitative trading, the what's, who's, and why's of quantitative trading. If you're curious enough to watch this video, you probably have heard of quantitative trading. But even for those who learned about this kind of trading from the mainstream media before, it is worth clearing up some common misconceptions. Quantitative trading, also known as algorithmic trading, is the trading of securities based strictly on the buy and sell decision of computer algorithms. The computer algorithms are designed and perhaps programmed by the traders themselves, based on the historical performance of the encoded strategy tested against historical financial data. Is quantitative trading just a fancy name for technical analysis then? Granted, a strategy based as technical analysis can be part of a quantitative trading system if it can be fully encoded as computer program. However, not all technical analysis can be regarded as quantitative trading. For example, certain chartist techniques such as look for the formation of a head and shoulders pattern might not be included in a quantitative trader's arsenal because they are quite subjective and may not be quantifiable. Yet quantitative trading includes more than just technical analysis. Many quantitative trading systems incorporate fundamental data in their inputs, numbers such as revenue, cash flow, debt-to-equity ratio, and others. After all, fundamental data are nothing but numbers, and computers can certainly crush any numbers that are fed into them. When it comes to judging the current financial performance of a company compared to its peers or compared to its historical performance, the computer is just as good as human financial analysis, and the computer can watch thousands of such companies all at once. Some advanced quantitative systems can even incorporate news events as inputs. Nowadays, it is possible to use a computer to parse and understand the news reports. After all, I used to be a researcher in this very field at IBM working on computer systems that can understand approximately what a document is about. So, you get the picture. As long as you can convert information into bits and bytes that the computer can understand, it can be regarded as part of a quantitative trading. Who can become a quantitative trader? It is true that most institutional quantitative traders receive their advanced degrees as physicists, mathematicians, engineers, or computer scientists. This kind of training is the hard sciences as often necessary when you want to analyze or trade complex derivative instruments. But those instruments are not the focus in this video. There is no law stating that one can become wealthy only by working with complicated financial instruments. In fact, One can become quite poor trading complex mortgage-backed securities as the financial crisis of 2007 and 8 and the demise of Bear Stearns have shown. The kind of quantitative trading I focus on is called statistical arbitrage trading. Thanks for watching. We hope you learn with our content. We will continue in next videos.